Good morning, and we are about to start. So last week, can you all hear me? You all can hear me, right? Right, okay. So last week we started off with books of prime entry, and we looked at cash versus credit transactions, and then the usefulness of it. And we also looked at some of the source documents, which are very basic for this purpose. So, and we also looked at what are the day books. So there are altogether 7. And I also explained what is a credit transaction is and the two sides to it. So let us look at what is T account is. So if you look at the entire system or the accounting system of an organization, it can be started with two sets of accounts that you may see. One is known as the personal accounts, the other one being impersonal accounts. So under the personal accounts, you probably get your debtors and creditors. Whereas in the case of impersonal accounts, you get all the real accounts, and we also call it as the nominal accounts. So what do you mean by real accounts is where you get all the assets, liabilities relating to your business is accounted. So you may have thousands of accounts which are relating to your assets and liabilities of the business. Similarly, there will be nominal accounts which are all relating to your income, expenses, and also your equity component, other equity components. So in other words, what you see under impersonal accounts is more or less relating to your accounting equation. Okay, so there is a small component which is going into the personal accounts, which is also part of your accounting equation, but the majority of the accounts sit under the impersonal accounts category. So what is so specific about personal accounts is where the personal accounts mainly fall into two categories. One is called the debtors, the other one being the creditors. And I explained who is a debtor and who is a creditor is. A debtor is who a person owes money to the business. From the business point of view, a person owing money to the business is called a debtor. Similarly, when the business owes money to somebody else outside, they are called creditors. And these debtors and creditors arise in the event of a credit sale or a credit purchase. When you are doing cash sales or cash purchases, these are not relevant. So you have to remember that it is only applicable in the case of a credit transaction. And we also learn what is called a control account. So control account relates to the sales and the purchases. So that is what we are going to look at basically. And now we start off with the sales day book. So what do you mean by sales day book is when you enter into a credit sale, you have to record it in your books. So the book that you are going to use is called a sales day book or a sales journal. Any name can be used for this purpose. So the sales day book will look like where that is visible in your screen now. You will have the date, the invoice number, that is the invoice that you raise for the sales. Then who is the buyer? Basically, the buyer means who is going to be your debtor. The debtor is your buyer. Then you will give some description relating to the transaction. And you will also say how many units were purchased by the customer or the debtor. Then what is the unit cost? If one unit is 100 rupees, you will state it in the unit cost column. And the amount column relates to what is in the unit cost and what is in the quantity multiplied by one the other, you will get the amount. Then this amount will have a running total. So every transaction that you do within the month, you will accumulate them in the total amount column. And the last column relates to the ledger in which you are going to record this transaction. So when you keep on doing this for a particular month, let's say for the month of May, once you complete and arrive at a total, which is called the total sales for the month, you will transfer the total sales of that particular month, which is credit sales, in the following manner. So we will post each sales transaction in the sales journal, and then you take it to the sales ledger. Sales ledger, very important. So what do you mean by sales ledger is where you will have your debtors account. You will have your debtors account. Now this debtors account is actually called the control account. Debtors account is called as the control account. So the double entry for this purpose will be you will debit sales and credit, sorry, you will debit debtors and credit sales. So give me a minute. So if you look at it, so we are talking about a credit sale, and the result of the credit sale is where you will debit debtors and credit sales. This is debtors account and this is sales account. A stroke C stands for short form of the account. So now this debtors account is also known as your control account. Is also known as your control account. So control account means where you will take the total in the sales journal and go and post it to the debtors account. But if you really look at it, there will be individual accounts maintained in the name of all the individual debtors. The total of all the individual debtors will add up to the debtors account. So it is very important that you note the debtors account is actually the total of all the individual debtors. Let's say Mr. A, Mr. B or ABC company, all those will be the individual debtors, the total of which is reported in the debtors account. So in the case of a credit sale, this is what ultimately happens. So the control account of debtors means it is the total of individual accounts. The total of individual accounts. So at this point in time, I would like to dictate a note. So I would appreciate if you can take down this. Take down. In businesses, credit transactions relating to sales, relating to sales, credit transactions relating to sales will be recorded, will be recorded, will be recorded in individual accounts, in individual accounts of customers, in individual accounts of customers. They are known as, they are known as, they are known as individual debtors, individual debtors. Individual debtors. Next line. Therefore, therefore, the totals recorded in the individual debtors, the totals recorded in the individual debtors, the totals recorded in the individual debtors will be equal, will be equal, will be equal to the total posted, to the total posted, to the total posted in the debtors control account, in the debtors control account, in the debtors control account. Debtors control account. So you would see the totals in the individual debtor account. So that is all what I wanted to dictate. So going back to what is on the board, the individual totals that is in the individual debtor accounts will add up to the total debtors account. So what happens in businesses, this is very important because as the business goes on, you will know that some of the customers or some of the debtors will come and pay on the due date and some might not pay. Some might not pay. So what happens that businesses will have to know when they take the total debtors, so likewise, let's say debtor A, debtor B, like C, D. Okay. So let's say debtor B comes and settles the amount A, and even D also settles. But rest of them are not yet settled. So they haven't paid to this company. Let's say this company is ABC company. So now in the books of ABC company, there is a total debtors amount which is equivalent to all these individual totals. Okay. So let's say as of the very next day, this person and this person pays. That is B and D pays. So by that amount, the total debtors will come down. So now the remaining total will be equivalent to only these four. Okay, these four. And we know that these 4 haven't paid on the due date. That is, if you given 3 months, they haven't paid within the 3 months. Now what happens when they don't pay on the due date? Their day count starts. Let's say this person is 1 day not paid and it is overdue for 1 day. This person, let's say, for 3 days. This is for 5 days and this is for 10 days. Now this day count is very important. So some of you might know that even when we give loans in the bank, when the customer doesn't pay, the day count starts. That is, the overdue day count starts. Like in the case of a credit card, where if we don't pay on the due date, there is an interest getting accumulated on the number of due dates that you have not paid. So likewise, in businesses also, this day counts starts. And that is very important for the business to monitor who are the debtors not yet paid and for how long they have not paid. Because that piece of information will be very useful when you are giving a credit period to the same customer or the debtor the next time. Because suppose if you have given this person 60 days credit, okay, 60 days credit. Obviously, the next time, you will cut down this person's 60 days, maybe to 50 days. Okay, because when you give actually 60 days means now he has taken 63 days. So as long as it is getting delayed, no point in giving them a higher credit period. You will cut down the credit period. Okay, but for people like B and D, where they have paid on due date or maybe before that, you might consider giving them a higher credit period. So this analysis is very important. This analysis is very important for businesses when they carry on businesses. Okay, and this analysis is called age analysis of debtors. Age analysis of debtors. Similarly, you can do an age analysis for creditors also, right? So what we mean here by age analysis is how long the debtors have not paid. That will be given in the age analysis report. Okay, so I would like you all to take down this so that it will be useful when you are answering exam questions. You need to know what is age analysis is. I'll give you about 2 minutes. So let's get back to the presentation. And as I told you, the transactions entered into the sales journal will be taken at the month end. The total is taken at the month end and it is posted to the general ledger and to the sales ledger, and the 2 accounts involved are debtors account will be debited with the total and sales account will be credited in the general ledger. Okay, so that is all about where a credit sales happens. Now the next topic is where the sales return happens. What does this mean is, when you are doing a credit sale, let's say you have sold 10 items of a product. So the buyer has taken those 10 products, accepted the 10 products, and there is an agreement for a credit period, let's say 30 days. And this person goes back to his office or workplace or home, wherever. Now, after going home, he looks at all the 10 items, maybe say after about 10-15 days, and to see that 2 items of the 10 items are damaged. So what do we do with this? No point in keeping it. So he will come back to the shop where he bought these 10 items. And now he will return these 2 items back to the seller. Back to the seller. So what has happened here? There is a credit sale and with a credit period of 30 days. And within this credit period, what happens? This customer or the buyer comes back to the company and says, look, two items of the 10 items I bought from you is not in good condition. So I would like to return it to you. I would like to return it to you. So if there is an agreement to accept any goods that is damaged not because of a physical intervention but due to other reasons, then the company will accept the goods and there will be a sales return recorded. A sales return recorded. Now let me explain this by way of the board for you to easily understand. So let's say there is a credit sale for 10 units at the rate of 150 rupees. Okay, so the total is 1,500. Okay, so the creditor, let's say this is ABC company and this is Mr. A who has bought it, right? So now the credit period offered is, let's say, 30 days, right? And now after about 5 days, Mr. A brings back 3 units. 3 units. Okay. So 3 units means at the rate of 150, at the rate of rupees 150, it will be rupees 450. So now this 450, this 450 is now does not belong to ABC company. What do you mean by that? They did a sale for 1,500 rupees, out of which now 450 does not belong to them. So when they did the sale, you know, the double entry would have been, assuming that this is the only transaction for the month, you would have debit debtors 1,500 and credit sales 1,500. Okay, this is what the journal entry. I think I gave you the journal entry last week. This is how we write the journal entry. That is debit debtors 1,500, credit sales 1,500. Now what happens? This 1,500, out of this 1,500, 450 does not belong to ABC company because they have accepted the returned 3 units. Let me say returned. So out of the 1,005, now 450 doesn't belong to ABC company. Alternatively, initially this person, Mr. A, was supposed to pay 1,500 to this company. Now he doesn't need to pay 450 back again, and only the remaining has to be paid. So what has actually happened here? Initially, when you did the sale, your debtors amount increased by 1005 and your sales also increased by 1005. But when the return happened, your earlier transactions of debtors and sales should come down by this amount. So this will come down by 450 and this also should come down by 450. But in accounting terms, what do we do here is, since this was considered to be a sale, this has to be considered as a sales return. This has to be considered as a sales return. This is called a sale and this is a sale return. As a result, the sale and the sales return have to be accounted separately. So we don't do accounting for the sale and the sales return as in the same way by going and reducing these amounts. No, we don't do it. So instead, what do we do here is we will go and debit an account called sales return. And that will get debited by 450. And the credit, of course, will go to the debtors account, because now this person need not pay 1500, he needs to pay less 450. So this is what actually a sales return means. When you do a credit sale, you record it in the debtors and the sales, but when the sales return happens, you don't go and debit the sales account. Instead, you record it in a sales return account. A new account is opened and that is debited with the total sales return for the particular month. But the credit will go to the debtors account because you need to reduce this amount by this amount. Okay? So I would like you all to take down this into your notes. I'll give you about 2 minutes. So going back to the presentation, now if you really see the sales return, as I told you, in the case of sales, you record it in the sales journal or the sales day book. Similarly, you will have a book which is called the sales return day book or the sales return journal or the return invoice journal, which will have all these information. Again, the date, invoice number, the invoice number here will be the original invoice, and the buyer will be the same person, description will be same, and the quantity here will be the number of quantity returned, and the rest of the things will be same as what you did earlier. So the total here will be not transferred to the sales account, but will be transferred to the sales return account. So that is what we have given here. This is called the returns invoice journal, and you will debit the return invoice account or the sales return account. You can call it by any name, return invoice account or the sales return account. And the credit will go to the debtors account. Any questions? If you have any questions, you may raise. Okay. So now, similar to the credit sale, the reverse of that will be the purchaser's journal. like the sales journal, now you will have a purchases journal. Now this is where you will do credit purchases. So I'm not going to write it again because it is the right opposite of the sales, credit sales. Now you are doing a credit purchase. Credit purchase means as a company, you are going and buying essentials or whatever you may call it. Say, let's say we go and purchase stationery for the business. So when you go and purchase stationery in bulk, you might ask for a credit period without paying immediately. So that person who is selling stationery might give you a credit period. So by offering the credit period, you become a debtor to that particular company, but that company will be a creditor for us. A creditor for us. So what do you mean by creditor? From the business point of view, I am supposed to pay a third party. I'm supposed to pay a third party. So what happens? You will record this in the purchases journal or the purchases day book, where you will enter the date, invoice number, the supplier who provided stationery to you, the description, let's say A4 papers, quantity 500 packets, each unit 1000 rupees. You will put the amount, the total running amount, and the relevant ledger. So end of the month, you will take the total of this purchases journal and you will transfer it, which is called the purchases account, where you will see the debit. So you will call debit an account called purchases and credit creditors. You will debit purchasers and credit creditors, similar to what you did in the sales, but the difference is only with regard to the accounting entries. So from the purchases journal, you take it to the purchases account and to the creditors account. Similarly, when you return a purchase, so let's say you have purchased 500 A4 packets. Out of those, 100 packets are damaged, where all the papers are spoiled and you are going to return those 100 packets. So now that is going to be a purchase return, or we call it as return outwards. The sales was written inward, now here it was written outwards. So when that happens, like what you did in the sales return, here you will credit an account called return outwards, and you will debit the creditors account. So before moving into the cash book, let me summarize what we did. Okay, so we have credit sale and we have credit purchase. Okay, credit sale and the credit purchase. So when the sale happens, the involvement is in the sales day book. And here it will be purchases day book. Okay. And the double entries would be debit debtors and credit sales. And here it will be debit purchases and creditors. Okay, so this is when the sales and purchase happen. right? So when it goes to the sales day book, here it goes to the purchases day book. From the sales day book, you take the total and debit the debtors and credit sales. Here you will debit the purchases account and here you credit the creditors account. Now similarly, there is a return. And here also there is a return. Okay, the sale is getting returned and the purchase you did also getting returned. So here it goes to sales return day book, and there it goes to purchasers return day book. Purchasers return day book. So again, when you look at the double entries here, sales return account. So this is what I have given in the note as return inwards. You can debit sales return or return inwards account. Both the names are same. And credit debtors account. And here you will debit the creditors and credit purchases return or return outputs. So this is the summary in a nutshell. A credit sale and a credit purchase. The books involve sales day book, sales return day book, purchase day book and purchase return day book. The result of the sales day book ended in the debtors and the sales return. Sales return will be going into sales return and debtors. Similarly, purchases day book goes into debit purchases and credit creditors, and the reversal of the purchases will be debit creditors and credit purchases. Okay, and you will see the four accounts involved here and the four accounts involved here. You will see this is going into the balance sheet. I will put B and S, balance sheet, because this is an asset. The sales will be going to your P&L because this is an income. This is an income. Okay. Here the sales return also goes to the P&L because it is a reversal of the income. Reversal of the income. Your income will get reduced. Here it is again to the balance sheet. And here the purchases account is a P&L account, and here it is a balance sheet, and here it is the balance sheet, and here it is the P&L. So this summary would be very useful for you to remember how you account for a credit sale and a credit purchase. So better if you can take it down for your record purposes to remember what kind of a double entries can happen when there is a credit sale or credit purchase or sales return or purchases return. So take about 2 minutes and quickly take down this. We come back to the presentation and we have the purchases return journal. This is last entry that I showed you. So with that, we will move on to the cash book. And if you have any questions. The board is not clearly visible. Okay. Is it Okay, I think some of you say that the board is clear. Right. Anyway, I'll say that I write it in larger letters. Right. So we'll get on to the fifth day book, which is called the cash book. So where you will record all your cash transactions of a business in this particular day book. So cash book keeps records of all cash transactions, cash receipts and cash payments. Cash receipts means whatever the form that you receive cash to your business. Somebody might give you as a payment of the debtor, or maybe something you will sell and receive cash. Those will be your cash receipts. Cash payments would be where you will pay for your purchases, or you might have to incur a miscellaneous payment for expense like utilities, electricity, water, whatever in your business. So all cash receipts and payments will be recorded in your cash book. All receipts, please note that all receipts are recorded on your debit side, because cash is a asset to you. Cash is an asset to you. So all assets by nature you will debit, and all payments will be recorded on the credit side. So what does it mean? Debiting means you are receiving cash, and crediting cash book means you are making a payment. So debit will relate to your cash inflow, and credit would relate to the cash outflow. We call it as a double column cash book, and the main columns are cash receipts and cash payments. And we also introduce two important terms which are called the discount allowed and discount received. Discount allowed and discount received. I'll explain what it is. Information from cash receipts book is used to update the nominal and general ledger accounts and the debtor ledger on a monthly basis. It all check payments and bank debits into your cash book. So the cash book is actually records all transactions which are relating to your cash receipts and payments. All receipts are recorded on the debit side or the left hand side. All payments are recorded on the credit side, or which is on the right side. Okay, and the main columns are cash receipts and cash payments, as we told you. And there are two more important columns, which is called the discount allowed and discount received. So what is this discount allowed and discount received? That is what we are going to look at next. So the discount takes two forms. One discount is called as trade discount, where the other discount is known as cash discount. And this summary gives you an idea on what is a trade discount and what is a cash discount. So this has been tested in the examination. So I would prefer if you can remember this definition, which is given as the description, and the purpose of it, and when it is allowed, and how do we record it. So I have given it in the table form, trade discount and the cash discount, and the criteria that we are supposed to look at. So what does the definition say? A trade discount is a discount given by the seller to the buyer as a deduction in the list price of the commodity is a trade discount. Whereas a cash discount is a deduction in the amount of invoice allowed by the seller to the buyer in return for immediate payment is cash. Now, I think you might have observed this in your day-to-day life, where when you go and buy goods from stores or maybe in the showrooms where they offer these two types of discounts. But generally, what we observe is the discount that we receive is a cash discount. Most likely, the trade discounts are not given on individual basis, because what happens is you have to make a purchase which is on bulk. But whereas the cash discount is a person who is trying to pay immediately, and if we are buying their product, then you will be given with a cash discount. Whereas in the case of a trade discount, you don't record it in your books. But when it comes to a cash discount, yes, you will record it in your books. So this is where the differentiation between trade discount and the cash discount comes. So let me explain in the board. So let's say I'm just taking a product, Samsung TVs, okay, and the PQR company is an agent of selling Samsung TVs, and we are looking at, let's say, inches televisions, and the standard price of a Samsung 40-inch television, let's say, 80,000, just for example. So the PQR company is an agent of selling Samsung televisions, 40 inches, at the price of 80,000. At the price of 80,000. Now we observe that there are two buyers. Buyer A and buyer B. Okay, there are two buyers. There is one buyer who is known as A coming to buy Samsung televisions, and buyer B is also coming to buy Samsung televisions. Buyer A wants only one unit. Okay. Buyer B wants 50 units. Buyer A wants 1 unit and buyer B wants 50 units of his 40-inch televisions. Okay. So buyer A goes to the shop and he sees that it is 80,000 and he wants to buy this, and he is trying to negotiate with the customer. He's trying to negotiate with the customer. So when he is trying to negotiate with the customer says, look, if you are paying in cash, I would give you this television if it is a cash, this television at 78,000 rupees. 78,000 rupees. Okay. If you are paying in cash, you can get this television at 78,000 rupees. Whereas buyer B goes and asks for 50 units and he wants to negotiate on this price. So in turn, let's make it 25 units for simplicity. So in turn, This company says, look, if you are buying 50 units from me, okay, if you are buying 50 units from me, I'll give you each at rupees 72,000. Rupees 72,000. So there is a clear difference between the two transactions. One person is trying to buy this television, only one unit, and it is at a price of 78,000, provided this person, buyer A, pays it in cash. But here it is a different transaction, where he wanted to buy 25 units of this television, but this person agrees, look, if you are buying 25 units, I will give it at this price, probably, or maybe 1,000 less. But if you are buying 50 units, I can give it to you at 72,000, which is 8,000 less per unit. So what is happening here? Here you are purchasing this product in bulk. We call it as a bulk purchase. We call it as a bulk purchase. So when you go and purchase in bulk, there is a benefit to both parties, because PQR company is going to sell 50 units immediately. That is a big amount of a sale. On the other side, buyer B is going to get 50 units at a price less than 8,000 compared to the price that was. We call this as the list price. So this is obviously an example which you will see when you go to these showrooms. Okay, I will just name few just for your knowledge purposes. Say you go to SoftLogic, or you go to Damro, or you go to Singer. In all these places, you observe this cash discount, or discount of 2% or 5%. What are these? What are they talking about? It is the same thing. It is about this particular transaction that is going to happen. If you are paying in cash, you are given a discount, that is 80,000 is given at 78,000. But when you are doing a transaction of this kind, where it is 80,000 worth unit, is given at 72,000. So this we call it as a bulk purchase. Bulk purchase, where the buyer B does a bulk purchase and getting a benefit of 8,000 rupees discount. Here buyer A is doing a transaction of a 1 unit, and he is getting a discount of 2,000 rupees because he is paying in cash. So you will see, when you get a discount of this kind, that is called cash discount. This is called a trade discount. You see, what is a trade discount and what is a cash discount? So the objective here is, why PQR company would give a trade discount is to encourage bulk sale, because they want to sell in bulk and this person want to buy in bulk. Okay, so when there is a bulk purchase happening, the seller would like to give a discount to the buyer, which is called the trade discount. But here what is happening, suppose Samsung TV is sold by PQR Limited, PQR company to this person, and this person is going to buy using a credit term, let's say, then he will not get this price. just because he's paying cash only, they are giving it at 78,000. So what is actually happening? Again, there is a benefit to both parties. Buyer A is getting 2,000 rupees benefit. But more than that, the PQR company is immediately getting cash. Where they don't need to go behind this person to collect the money later. They are getting immediately 78,000. So what does here is to encourage payment. Encourage payment. So the objectives are very clear. In the case of a cash discount, the objective is to encourage payment. You pay immediately. I'll give you a discount. Here, you are trying to sell more, so you buy more products from me, I'll give you a discount, which is called the trade discount. Okay? So I would want you to take down this, because this example would help you to understand more the cash discount and the trade discount. Can you take down? So in exams, you might be sometimes asked to define what is a credit discount and what is a cash discount. So you can write what is there given under the description for this purpose. And you also need to know what is the purpose of giving a trade discount and giving a cash discount. So for a trade discount, the purpose is to encourage bulk sales or bulk purchase. And the cash discount is to facilitate a prompt payment by the buyer. When are you going to allow this? Yes. Trade discount is allowed at the time of purchase, and cash discount is allowed at the time of payment. At the time of payment. Whether you record entries in the books, in the case of a trade discount, you don't record anything that is relating to the discount. Please note that. In the case of a trade discount, you don't record anything relating to the discount, but you will record the sales. Here in the case of a cash discount, you will record the result of the discount as well. Okay, so you need to be very clear on that. So now let us look at this example. Okay, we are going into the cash book. The cash balance of MN Company as at 1/1/2019 was 50,000. They deposited rupees 30,000 in the bank to open a current account for business transactions. The transactions of the business in the month of September are stated below. All checks are deposited in the following days as per the company policy. So this is an example where there are a lot of transactions also given. Okay. So there are about altogether, I think 1, 2, 3, 4. Altogether 9 transactions are there. Okay. So what is important is here, you need to know I would take this. This is the continuation of the transactions. And if you see the table below that, the table shown below the for transactions is actually the actual cash books that we are talking about. Actual cash book that we are talking about. This is the cash book actually. So if you really look at it, the cash book has 2 sides to it. One is known as the debit side, the other one is known as the credit side. Okay. So I'm going to switch you all to the screen. So I hope it's visible to you all. The board is visible to you all. Now this is the cash book, and this is a rough sketch what you saw in the presentation slide. It is the same as that, but for exam purposes, we generally do a cash book of this kind. Okay. Now, if you really look at it, this cash book has this is the important line. There will be 5 columns to your left side and 5 columns to the right side. 5 columns to your left side and 5 columns to your right side. So what do we do here? The first column to record the date, particulars. In the presentation, you will have more columns, which I am not going to relate now. Cash, bank, okay, cash, bank, right? And you will also see there is a column here called discount allowed. And here again, date, particulars, cash, bank, and again here we have discount received. You see the two types of discounts that we spoke about, trade discount and cash discount. Now out of the trade discount and cash discount, I said trade discount is not recorded in the books. So you understand by that is these two columns, what is here and it is the last column, relates to the cash discounts, So we are supposed to record only the cash discounts here and here, depending on the circumstance. Sometimes you might receive discounts, sometimes you might allow discounts, sometimes you might receive discounts. So the important thing here is whether you receive or allow. Depending on that, you will do it. But again, this is at the time of cash payments. So basically these two columns relate to cash discounts. What are the other columns relating to the cash flow? So here you have a debit side. The columns are date of the transaction, the particulars of the transaction, whether it is a transaction that happened in the cash, form of cash, or it relates to your bank account. Okay. Now here comes an important factor. When you look at the cash book or not only relate to the physical cash that you have, but also anything that you have in your bank account. Okay. That is what this column is. So the bank column relates to all transactions that you may come across in your bank account. So the bank account is also considered like cash. Bank account is also considered like cash. That's why in the description I said all the check payments or receipts are recorded in the cash book. The physical cash, you know, that is recorded in this column and in this column. But all transactions relating to your bank is recorded in this column. Okay. So what does this mean? From here to here, that is your left side, all the debits going into your cash and into your bank. And what we record here is all receipts. On this side, date, particulars, cash, bank, and discount received. Again, this relates to all payments. You see? All payments. So all receipts of your business, whether it is in the cash form or into your bank, are recorded on the left side. All payments relating to your business in cash or in bank form are recorded on the right side. What are the columns? Date, particulars, cash, bank, discount allowed. Date, particulars, cash, bank, discount. Now we say this as a double column cash book. Double column cash book. Why you call it as a double column cash book is because these two columns. You have a cash column and you have a bank column. And here also you have a cash column and the bank column. So the concept here is when you have these two columns sitting in your cash book, that is called a double column cash book. Okay. And this is how you will have to prepare in case if you are required to prepare a cash book in your examination. But then again, you might be wondering where this is coming from. If you look at a bank, in your banking business, you don't get a cash book. You don't get a cash book. We don't record it like this. But the underlying transactions are recorded in your computer systems. Likewise, what you do. So that is the only difference, that what we learn here is always targeting the manual book entry system. But today we are not practicing this, but we are doing the same thing in the form of a computer system. Okay, so that you have to remember. Always, whatever that you learn, you have to be in a position to relate it to your current context. That is what is going to be the ultimate learning outcome. Whether how does this apply to my current context? So I will give you a simple example. When a customer comes to deposit cash, what is the double entry? You will receive cash, so it is a receipt. So you will debit your cash and credit your customer. So ultimately, what is happening? Your cash receipt is supposed to be recorded here. That is what you are doing in your computer system. Similarly, let us assume a customer is coming to withdraw 10,000 rupees from the customer's account. So now what is going to happen? You are going to make a payment. Payment means you are going to give out cash for the withdrawal, over the counter withdrawal. So cash is going to go out. And this is where you record your 10,000 relating to the customer. And the customer account will be debited. Customer account will be debited. Okay. So I want you all to take down this. After that, we will do the example. Can you all quickly take down? So what are we going to do now is we are going to record the transactions that are given there in the presentation slide into this cash book. So how are we going to start with this? If you read the question, it says the cash balance of MN company as at 1/1/2019 was 50,000 rupees. Okay, Now the 50,000 rupees is actually your cash balance. Your cash balance. Which means you are having an asset which is your cash, and the amount is rupees 50,000. So we say the date is 1/1/19 and we call it as balance brought forward. Balance brought forward. And we say it is 50,000. Is 50,000. Okay, 50,000. And they also say they deposited rupees 30,000 in the bank to open a current account for business transactions. Okay, so they also deposited 30,000 in the bank account to open a current account for the business. So what happens? They have 50,000 of cash in their books. And then they are going to open a bank account. They are going to open a bank account. So how are they going to open a bank account is they are going to take 50,000 and out of which 30,000 is going to be taken now. That is what they say. And they are going to go and deposit that 30,000 in their bank account. Now the question here is 30,000 is going to go out from your cash. 30,000 is going to go out from your cash. Now how does that go out? That is from here. That is from here. Now the 30,000 that is going to go out is going to where? It is to your bank account. So which means you will receive cash into your bank account. You see, cash is going out from your cash and coming to your bank account. So let's say here it is going to be bank deposit. And you will get 30,000 here. It. Okay. And call this as cash deposit. And there it is called the time deposit. So you see, the business started with 50,000. Out of that 50,000, now 30,000 has gone out. So the remaining is 20,000. But the 30,000 that went out is actually went into your bank account. Came into your. So the double entry here is you have debited your bank and credited your cash. Okay. Now since we have done the journals, we know what is the journal entries and what is double entry is. You always should remember how do we account for these transactions. So here we have a debit and a credit. The debit is to your bank account, credit is to your cash account. But the only difference here is since this is a double column cash book, you have the cash and bank sitting together. So this is basically your cash account. This is your bank account. That is what you need to remember. And I also want you all to record these two transactions now. And you always remember, this is like a T account. You see? It's like the T account. Left side and the right side. So I'm recording the debits on this side and credits on this side. But the difference here is, instead of a single account, here we are handling with two accounts, which is your cash and the bank. And both are handled simultaneously. Okay? And then we go on to the first transaction. Oh, before that, if you look at the description, it says the transactions of the business in the month of September are stated below. And then they also say all checks are deposited in the following day as per the company policy. So what does the company policy? If you look at a transaction where you have received a check today from one of your debtors, that will be recorded as a check received today, but it will be deposited in the bank on the subsequent day. On the subsequent day. So based on that policy, let's look at the transactions now. The first transaction, say on 1/9/2019, a check of rupees 10,000 paid to JD Limited. So what do you understand by that? A check has been paid for rupees 10,000 and it is paid to JD Limited. So the JD Limited is one of your creditors. JD Limited is one of your creditors, let's assume. So you have paid them rupees 10,000 by giving a check. So when you give a check, what happens? The money will go out from your bank. The money will go out from your bank account, because when you give a check means the supplier will take the payment by way of a check. You are not paying cash. So the money that is going to go out is from your bank. So what you do here, on 1st of September, you are paying JD Limited and the amount is 10,000. And the amount is 10,000. So this is how you record this transaction. Rupees 10,000 has been paid to JD Limited on 1st September. Because you already have 30,000. So you can easily pay 10,000. So I want you all to record these transactions together with me as I record this transaction. Then the second transaction, they say on 2nd September, rupees 12,000 received by check from Madurai. Now what is happening? You are receiving money from one of your debtors. Receiving money from one of your debtors. And how this person is giving it to you? He is not giving it to you in cash form. He is not giving it to you in cash form. He is giving it by way of a check. By way of a check. So this is where you have to remember a special characteristics with regard to this particular transaction. Whenever a business receives checks for payments that they are supposed to receive, the checks are immediately recorded as like cash received. Because this question clearly says all checks received are deposited on the following day. Can you remember the policy? You can go back to the policy and see. The policy clearly says all checks are deposited in the following day as per the company policy. What do you mean by that? If you receive a check today, you are not going to go and deposit it in the bank on the same day. You are going to deposit it in the following day. Why this is done? Because on a particular day, you might get lot of checks. You might get lot of checks. So what you need to do, you have to record all those, total it up, and then only you can go and put it to the bank. But in practical scenario, some of the businesses, they do it on the same day itself. That is why you see some of the times in your respective organization, that is in the banks, the customers running and coming to your bank by about 2:55, 3 o'clock, or some branches operating at 4 o'clock means they come closer to 4 o'clock, running and chasing, getting the checks to be deposited to the account. That is because they want somehow the checks to go on the same day. But there are certain businesses where they go and deposit it on the following day. So until you deposit the checks in the bank, you record it as you have received cash. You have received cash. So in this particular question, the check for 12,000 rupees on 2nd September from Madura will be received and recorded as a check, cash immediately. Okay. So they say this particular check is now going to be deposited into the bank on the very next day. So the very next day here, of course, we say that it has to be 3rd of September, but for simplicity, let's take this next business day. So the next business day here is 4th September. Now on 4th September, what is going to happen? Before you record the transaction that is given, you have to record this as a check that is deposited into your bank. So when you deposit your check into the bank, what happens? It is somewhat similar to depositing this 30,000 in the bank initially. So what do? You will deposit 12,000, you will credit your cash and debit your bank. And you will say here, check deposit. Okay. Or you can call it as the same Madura. And here you call it as check deposit. That is on the 4th of September. So now what happens? The cash debit that you put and the cash credit gets wiped off. And the check that you received is now in the bank. Okay. Next transaction given there is where on 4th September, rupees 1,700 paid to settle the monthly electricity bill. So now you are going to pay 1,700 rupees to settle your electricity bill. Now when you are settling your electricity bill means cash is going to go out. So which means it is a payment. It is a payment. So how will you record this transaction? What would be the double entry? When you are making a payment. Payment means you are incurring an expense here. So your debit account would be electricity expenses. And the credit would be where cash is going to go out. So on 4th September, you are going to pay electricity and it is 1,700. And the next transaction is where on 5th September it says rupees 5,000 paid by check for salaries. Now again there is an expense, but you are paying it using your check. So on 5th September, there is a cash outflow, which is salaries, and you are paying it by way of check. So your 5,000 will be onto the bank column, onto the bank column. Then on 6th September, again, you have received a check from co-leader. So 6th September means it is the same as what you did for Madura. So co-leader, you will say 17,000, and that is the only transaction that has happened on the 6th. So you know, before proceeding further, on the next working day, which is on the 7th September, what you should do? Transfer this 17,000 from the cash to the bank. So on 7th September, again, this 17,000 will go into the bank column, and on 7th September, you will deposit a check which is from your cash. Okay. So what am I going to do is actually, I'm going to leave the balance 4 transactions to you. Balance 4 transactions for you to go through and record it in the cash book. Okay. And then also remember, you have to do a balancing of this account. Balancing of this account, which means you go to the very end, that is considering you have reached the month end, and you need to balance. So your debit side is here for cash, credit side is here for cash. So you have to do a balancing and carry forward the balance. Similarly, for the bank column also, you need to balance it. The debit side here, credit side here, you have to do a balancing. Okay, so that is what your homework is, where you need to complete the balance 4 transactions that are given here based on your understanding, and also ensure that you do a balancing of the cash book, both columns, cash column as well as the bank column. Okay. So complete these 4 transactions and then balance the cash book. So apart from the cash book, we have another day book which is known as the petty cash book. So what is the importance of a petty cash book? Now this petty cash book is mostly used to incur small nature of expenses. Small nature of expenses means, now in business concerns, the cash accountant who is handling the cash is generally focusing on all the transactions that are happening through at largest scale. That is with the debtors, creditors, making supplier payments, all those will be handled by the main cash officer. But when there are requirement for smaller nature of expenses, like say, suppose you are not, your photocopy machine is broken and you want to take some photocopies. So you might send your office assistant to take some photocopies from outside, where you might have to pay 20-30 rupees. Or there could be instances where you might have to deliver a document to maybe to central bank or maybe to some other company or to any other outsider. So you might get your office assistant to go and hand it over. And this office assistant might use a taxi for this purpose to go and hand it over and come back. So which might cost you about 300-400 rupees. Now these type of small expenses cannot be handled by the cash officer because he will be not interested in doing that small nature of transaction. So what happens in businesses, even in banks, you might see a smaller portion of the cash will be given to an officer who is called the petty cash officer. This petty cash officer will handle these kind of payments in the absence of the main cash officer to handle these type of transactions. So the objective of petty cash officer is, or the petty cash book is to record all small kind of transactions or small nature of transaction that may happen within a business. The petty cash book operates on a system called the Impress system. The Impress system. Why it is called Impress system? Let me come back to it later. But let us look at what this petty cash book says. So now, in order for you to handle the petty cash, what happens? From the main cashier, you will get a fixed sum. Let's say 50,000 per month. So you get 50,000 at the beginning of each month from the main cash officer for you to record these or to carry out these transactions. Now the money that you receive from the main cash officer is called the float amount. The float amount. So you are given a 50,000 rupee from the main cash officer for you to handle these transactions. And as I told you, the petty cash officer will record all small cash receipts and payments. And let me come back to the main columns of the petty cash once I explain this in the board. The analyst columns are used to group similar payments such as stationery, postage, etc., which we will handle. Okay, and information from the petty cash book is used to update the nominal and general ledger on a monthly basis. Now let's go back to the board and I'll explain you what this petty cash will do. So we have been working on this cash book, as you know. This is not relating to the earlier example, but I'm going to use the same board, same structure to show you what is going to happen under cash book. Okay. Right. Now let's assume your company cash book at present has 50,000 rupees. And you have decided to start with a petty cash in your business. You would like to give the petty cash officer with 20,000 rupees. So at the beginning of the month, you would like to give this petty cash officer a 20,000 rupees. So what happens? It goes out from the cash book, let's say on 1st of July. So on 1st of July, you are going to give to the petty cash officer rupees 20,000. And now this petty cash officer will start his account with 20,000 rupees. Okay. In simple terms, what have you done? You have debited an account called petty cash account and you are crediting your main cash account. So this is now going to be handled by your petty cash officer. And this is going to be handled by your main cash officer. So this is more or less applicable to normal businesses, but banks also do practice this, but in a small nature. But the normal companies do this at a greater scale. So there will be a main person who is the accountant or the cash officer in the business, who is looking after the cash book of the business. But from the cash officer or the accountant, there will be a smaller portion taken, like this 20,000, and given to a person called the petty cash officer. So the petty cash officer is the person who is going to handle the smaller nature of transactions with this amount given to him. This amount is the one known as the float amount. The float amount. So every time at the beginning of the month, this petty cash officer will have 20,000 in his pocket for him to look after the expenses for the particular month. Okay. That type of a mechanism is called the impress system. What you saw in the slide as impress system is that. That is, every month, at the beginning of the month, you are ensured that you have 20,000. Now, this amount of 20,000 can vary from company to company. Maybe you also can revise this every time, considering the amount of transactions that are happening in your business on a particular month. So, suppose if you exceed this 20,000 in this month, you might increase it to 30,000 when you go to next month. But it is a constant amount that you take at the beginning of every month. That system is called an impress system. Impressed. Impressed. What do you mean by impressed is every month at the beginning you are relinquished with this amount for your transactions. So you are given like 20,000 or 30,000 or 50,000 by the cash officer at the beginning of every month for you to handle these transactions. But what happens here is, like the cash book, the petty cash also has a separate book. That is why we call it as a petty cash book. So once you receive this float amount, you need to record it in your petty cash book. So if you really look at it, there is an example which I have given in your presentation slides, where to record the following transaction in the petty cash book of Martin Limited for April 2019, and you are required to record these transactions with the following headings, that is postage, canteen and sundries. Okay, and there are about 5 transactions which you have to record in the petty cash book. Let's try to record these in the petty cash book. So your petty cash book will look like something similar to this. This can be formulated in any way that you like, but you have to ensure that you record all transactions. Okay. So what happens in the petty cash book is, if you look at the example, it says in the month of April, you are starting with an impress amount of 20,000. So let's say on 1st of April, your impressed will be 20,000. So this 20,000 is given to you now to expend during the month. And now you are also given some transactions. So on 3rd April, you say that you have stamps purchased for 300 rupees. Now what do we do here is, we need to maintain a record of each expense in detail. So what do we do here? We maintain a record of the types of expenses that we incur. Say for example, you have stamps. You have stamps. So on 3rd of April, you purchase stamps, which is 300. And the next item will be on 5th April, there is a coffee voucher which is for 150. So there had been a visitor and you have given coffee. So here we will say this was given to the, let's say, canteen. So whatever you buy from the canteen, you put it to there. Your canteen expenses 150. And then you also given something, some donation of a small kind on 7th of April, which is for charity. And that you can put it as charity if you want, or you can say sundries. So that will be 5,000 here. And the last transaction on 8th April, again you have purchased stamps for 1,800. Okay. So now you reach the month end, assuming that this question doesn't have any other transaction, you reach the month end. So at the month end, what you do, you take a total of all these. So 1,008, 300 means 2,100. Here you have 150, here you have 5,000. Okay. So after taking 20,000 from the main cash officer, you have spent 2,100 for stamps, 150 for canteen, 5,000 rupees for the sundry. Now, from where did you expend all these? From here. So what you need to do is, at the month end, let's say on 30th April, okay, total expenses would be, you have to reverse all these amounts and that total will come here. Which is 7,250. Okay. 5,000, 2,100, and 150 means 7,250. So the balance is now how much? 12,750. 12,750. Now what will happen when you go to the month of May, that is next month, again you have to start with 20,000. You have to start with 20,000. So you will go back to your main cash officer with these details and all the invoices and everything, whatever the receipts that you have, bills and everything that you have got, go and hand it over to your main cash officer and you collect 7,250 from the main cash. And when you bring it into your cash, petty cash book, 12,750 plus 7,250, again, you will have the 20,000. So this is what is called as the impress system, where you continuously do transactions, get it replenished from the petty main cash officer. This mechanism is called an impress system of petty cash. So I think we have reached 10 o'clock. So let us stop here. And if you have any questions, just you may send it. Have it ready next week. We will discuss that. And also, please try to complete the homework that I told you before we start on with the new section. Next week, I'm planning to have the bank reconciliation. So I would like you to revise all the work that we have done so far, especially on what we learned today. And with regard to the cash book, you have to be very clear because we are going into an important topic, which is called the bank reconciliation. Okay. Right. So we'll stop there and see you next week. Have a pleasant weekend.